Hi everyone, welcome to my channel. Today I'm going to share with you my thoughts on how quickly the economy can recover from COVID-19. In this video, I'm going to explain the different shapes of economic recoveries and try to answer which type of recovery is the most likely. I'm also going to talk about the current situation of the economy in Asia, mainly in China, and why I think US and Canada are going to have 90% economies for a while. And I'm also going to talk about the biggest risks going forward for the stock market. Most people already know that whether the stock market will keep going up largely depends on how quickly the economy can recover. If the economy recovers quickly, then the current stock market rally can be justified. However, if the economy doesn't recover as fast as expected, then the stock market can either enter a phase of ups and downs or possibly a drop. S&P 500 has already recovered over 90% of its previous high in February. Most investors possibly don't know the answers to two important questions. What is currently priced in the market? And is this pricing fair? I'm going to explain these in just a second. The current stock market rally is mainly due to Fed and central banks' quantitative easing program and historically low interest rates.
Every investment is a lump sum payment of future cash flows. So if you need the stock price to go up, you either need a company to generate increasing future profits, or you need a lower discount rate, which is based on the Fed's interest rate. That is what drives up the stock market right now.
If you're not sure the exact correlation of Fed's printing money and the stock market rally, after finishing this video, you can check out this video where I explain why Fed's printing money make the stock price go up. As I just mentioned, there are only two factors that affect the stock price: future cash flow and interest rate. As I am making this video, the market is pricing in earnings around 168 by the end of 2020, where the earnings estimate is at 128. Before the S&P 500 started to drop in February, the market was pricing in earnings around 175. Just by looking at the earnings potential, the market is too optimistic at the moment. Also look at forward earnings yield. Earnings will go back to pre-COVID level during the second quarter of 2021, which I think is a fair estimate. Monetary impact has been increasing since 1982 when Ronald Reagan took the office and started the supply-side economics. Interest rate and monetary response is also the most important driver in the current stock market rally. So is the stock market fairly priced related to interest rate? The most analogous recession is the 2008 financial crisis. Because it was the first time the Fed used QE, stock market rally was mainly due to Fed's easy money, and this time is the same. If you look at the average risk premium since the start of the recovery 10 years ago, it's around 2.7. Now the 6-month forward risk premium is around 2.6, which is a bit below average. This means the market is now overpriced. If you don't know what risk premium is, think of it as how much return you can get from the stock market versus other interest-bearing assets like government bonds. If the risk premium is high, it means that the market requires more return for the risk they're taking. An average or low risk premium is saying that the market is willing to take on more risk for less return. By looking at the earnings potential as well as interest rate, it's reasonable to say that the market now is overpriced. Now you may have an idea of what's currently priced in the market. You might be wondering, is the economy going to recover as fast as expected? In fact, how quickly the economy can recover largely determines which direction the stock market is going to take. And historically, the market can be overpriced for a long time. We'd better take a look at how the economy is going to play out in order to decide how to position ourselves.
There's no one number to measure economic recovery. When we're looking at the speed of the recovery, we mainly look at two things: GDP and unemployment. So what do these mean? When people go out to buy houses, cars, or smartphones, businesses generate revenue. These revenue can be used to make investments, initiate new projects, or hire more people. When people are working and businesses are operating, we have economic activity. And GDP measures the total amount of money produced by these activities. When GDP was able to rebound quickly and people were able to get their jobs back, meaning the unemployment rate falls fast, we call this the V-shaped recovery. In 1953, growth began to slow in the third quarter. However, However, by the fourth quarter of 1954, the economy was growing at an 8% rate. It only took 1 year for the S&P 500 to reach its previous high. This is a V-shaped recovery. Similarly, a U-shaped recovery means economic activity gets back slower than the V-shape, resembling the shape of U. The 1973 to 75 recession can be considered a U-shaped recovery. The stock market didn't recover its previous high until a decade later in 1987. The L-shaped recovery is the worst of all kinds. The lost decade in Japan was an example of L-shaped recovery. As I mentioned before, the most analogous period to the current recession is the 2008 financial crisis. After the 2008 financial crisis, even GDP bounced back quickly. The unemployment rate didn't fall below 5% until the end of 2015. We entered into a period of slow growth. S&P 500 was not able to get back to its previous level until 5 years later.
If you look at history since 1945, if the stock market declines between 20 to 40%, the average time to recover is 15 months. Now we have a more steep recession than 2008 with 15% unemployment and even more possibly economic contraction. The stock market has already pulled back over 90% of its previous high in February. It's a bit too fast. It's pretty obvious that the market is pricing in a V-shaped recovery. But is it correct? Let's look at China, who was the first one to lift the lockdown from COVID-19.
China was the first one to impose the lockdown and the first one to lift it. Other than Hubei province where the outbreak originated, China lifted most of its lockdown in late February or early March. Nowadays, even though most people are still wearing masks in China, people are able to enjoy their favorite restaurants. Millions of people are already traveling by air. Hotels are starting to see people coming in. More importantly, even with fewer new export orders, the manufacturing sector starts to expand in May. Not just manufacturing, as I mentioned, more businesses in service industries such as restaurants, hotels, and tourist agencies have been getting back to work. The sharp rise in the Caixin Services PMI above 50 tells us the recovery of the economy in China's service sector. While China's example is encouraging, if you look at other countries in Asia, things are not looking that good. Other than China, most Asian countries, including South Korea, who was the very first to win the battle against COVID, are still struggling due to its heavy reliance on export orders. So what about US and Canada or the Western countries as a whole?
I think China's case is a best case scenario, and I don't think the US or the world will recover as fast as China. Going forward, we're most likely going to have what I call a 90% economy, which I'll explain in a second.
First of all, social distancing rules still apply. It means longer time for businesses to return to full capacity. Take restaurants for example. During the lockdown, restaurants are closed. It had to lay people off. So for the ones that were not able to pay their rent, they were closed permanently. This leads to a cut in income for commercial real estate companies, which means higher possibility for the mortgage default, which causes problem for banks. Even after the lockdown is lifted, you may not see a restaurant full of people, which means less hiring and more unemployment. Some industries will not see customers coming back very soon, such as international travels, hotel, entertainment venues like museums and theaters, because of the leftover fear of catching the virus. In a recent survey sent out to Canadians, most people prefer the border remain closed after COVID, which I totally agree, because you only need one infected traveler to kick out a second spread.
The biggest problem I see is a long way away for all laid-off workers to get back to work, which means a U-shaped or even an L-shaped recovery in the economy. So for the stock market, what are the biggest risks going forward? There are 3 risks on the horizon that I think every investor should know. First, the economy recovers slower than expected. Clearly, the market is pricing in a V-shaped recovery. However, I'm speculating that the unemployment rate will not go back to previous low in 6 months or even in 2 years. So if the economy recovers slower than expected, the market will adjust to it immediately. Second, domestic and international conflicts. Ray Dalio has been addressing this problem for years. Basically, what he's saying is that the wealth gap is the highest since the 1930s. Conflicts are rising between the rich and the poor. Deglobalization is also emerging. These are the root causes why you see protests, trade wars, referendums, or Brexits. Conflicts become more intense when there's an unstable economic environment, which is what we have now. This could lead to trade wars or actual wars, which means tariffs, economic destructions, and stock market correction. Third, second wave triggers second lockdown. We've already started enjoying the summer, but imagine when summer ends, how people are going to feel about the virus. They might be worried that the virus may be coming back. With the cooling weather, people may choose to stay home instead of going out to spend. The second wave is the scariest of all. The economy may halt again, and stock market may be going down again. Government may send out money for the second time, which will hurt their already troubled balance sheet. As I mentioned before, you only need one infected person to start a second wave. I think the point of this video is not to convince people that things are getting worse or they are going to get better, but just to help people see realistically what has happened before and kind of remind people as to what's going to happen to the stock market or the economy as a whole. I see a lot of people trying to predict what's going to happen next. Some people say there's going to be another stock market crash or this is going to recover quickly. But there are a lot of uncertainties here. In the world of investments, the wise investors are those who admit what they don't know or they can't know certain things, such as the length of a downturn or how quickly the economy can recover. Investing is about taking a measured approach, not looking at things binary, like there's going to be a recession so I'm going to sell everything, or things are looking good now so I'm going to go all in. The most common mistakes of investing is to assume that the investments that has the highest return in the past are the best investments, rather than they have already become expensive. If there's only one thing to take away from this video, is to realize that there's certain things that we simply can't predict. Be humble. For how to position yourself, think about your risk tolerance, diversify properly, and try to learn as much as possible about the topic you're interested in. Thanks for watching, guys. If you like my video, try to like, subscribe, or leave a comment in the comment section below. I hope to see you in the next video.